Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Chad here, your hosts for this weekend show. Also your hosts on our website, podcast, YouTube channel, and Substack account. Just search the KE Report, and that's where you can find all our daily editorials and company updates from throughout the week, as well as the full weekend show, because for all of you listening on the radio, we do have to cut down these segments for the radio. But all of you listening on our website, podcast, and YouTube, this is the full weekend show for you. Front half of the show, we're going to be looking at markets more broadly and covering an upcoming conference that Chad and I are both going to, a MoneyShow conference in Las Vegas, February 23rd to 25th. Back half of the show, a focus on mostly precious metal stocks, but we're also going to be diving into a little bit some of the other commodity and metal stocks, all of which are performing well, but I think you're going to be interested to hear what we think about some of the reactions and ratios that we're seeing from underlying metals compared to the stocks. Let's get into the first half of this show with Mike Larson. Mike is the editor-in-chief at MoneyShow. And Chad and I are going to our first Money Show down in Las Vegas, February 23rd to 25th at the Paris Hotel. Mike, I'm personally very excited to go to this conference. It's been a while since I've been excited to get to a conference. We go to a lot of conferences, but a lot of the ones are ones that I've been to and very much focused on resource investing, even though investing in resources right now and in the last couple of years has been great. Money Show is, from my understanding, more general. Let's talk about what we should expect when we attend and how people can sign up to go there, please.
Yeah, absolutely, Corey. Thanks for having me on the show. You know, Money Show in Las Vegas and the events we do around the country all year long. You're right, we're not metals focused. We tend to sort of, I guess it's appropriate since we're talking about Vegas, we try and give people a buffet or smorgasbord of education. So it's going to cover, their income stocks, their growth stocks, sectors like mining, but also AI, financials, industrials. We're going to have people speaking on financial planning. We're going to have people speaking on, tax planning. We have people speaking on all kinds of crypto and all kinds of other asset classes and investing approaches, as well as a lot of trading educators. I mean, the Vegas audience, we tend to sort of tilt a little more trading oriented versus some of the other conferences that tend to have more, a little bit more of a long-term investor type audience. So we cater to that. We've got live trading demonstrations. We've got sort of these deep dive 2-hour Money Masters trading courses. We've got all kinds of things that are basically designed to give you ideas, to help you round out your portfolio and educate you on everything or every asset class you either already own or maybe you should think about owning. So, that is how we differ. Obviously, we're happy that you're going to be there to do some of your work on site there, maybe interview some guests and so on for your show. And that's part of the extras that we throw in. We do a podcaster's corner where people can, watch live interviews going on. We've got themed receptions. We've got a poker night if that's your thing and you want to kind of match wits and try and bluff your way to the top of the pot. Against some fellow attendees and speakers. It's designed to be a lot of fun. It's designed to cover a lot of ground, and we're just really excited about this February's event.
Well, Mike, you have a couple events per year in different cities. I know you do some in Orlando and other cities as well. Out of all the speakers that you've heard in 2025, let's just look back at last year and then project forward into this year. Are there any themes that really caught fire last year that may surprise people listening or at least reinforce where their trading is? Or is there any themes coming into 2026 from all the different speakers that you think are getting a disproportionate amount of interest right now from investors?
I think that tech, AI related stocks and companies and stocks that sell into that sector or that are serving that sector, whether it's utilities, grid operators, companies that service and sell materials and services into all these data centers that are being built around the country. That's been a hot topic. It's in the news. The volume on the bull, bear, bubble kind of debate in that sector has really amped up. So people are looking for answers on that, and we try and, give them the best information our experts can. And as you would expect, a lot of the picks in that sector that people have given in previous years have done very well. naturally, given what we're talking about, what we're seeing in the mining sector or the metal sector, goodness, I mean, it's been an incredible already 2026 in that space, and certainly 2025 was a phenomenal year in the resource sector. So, people have been very much paying attention to what's going on there. It took a while for that to ramp up, which, it's interesting as the sector started to move. There was still probably more interest, especially from some of our younger attendees in crypto, but now people are noticing. You can't not notice what's happening in the metal sector. So there's more more attention being paid there. I think there's always the kind of background steady Eddie type stuff that's popular. It's the high yield plays, BDCs, and some of those companies got hit pretty hard last year. But I know a lot of, income oriented, and especially some of the older attendees that are looking for that type of guidance and that type of knowledge. Those picks and the people who speak on them are always, always sort of well followed and people are paying attention. So those are a few of the themes that I'd note. And and again, it's interesting, and we obviously try to cater to what's going on in the market and what people are interested in by, shading the program in certain directions, having more metals people and speakers when metals are hot, having more people speaking on AI or crypto when that's hot. But, we do try and, kind of keep in the background that we're serving generalist investors, especially at the show in Vegas in February and the Orlando big show that we have in October, and make sure we're, doing a little something for everybody.
So, Mike, these days, when you go to these conferences, there's so many speakers, different stages, different areas for people to spend their time at. And these days, in all fairness, they can get a little bit long for people listening to all these talks and trying to take in all that information. What do you recommend people do to plan their day at this show to make sure that they are getting the most out of it, but also make sure that they're getting a balanced perspective?
Yeah, absolutely. A few weeks before the show, we'll have a final program that we put out. It's a PDF document that's available online. We send it out via email to everybody who's registered and say, hey, here's your final program. And it's all, you want to make this fun. You don't want to make it be like a final exam, but I always kind of joke you might want to study up a little bit, see who's speaking, when they're speaking, where they're speaking, and kind of use that. You can print it out at home and use it as a matrix. We do also have a Money Show app. If you're more technologically inclined and you don't want to have all that paper, no worries. You can search every speaker in the app and it'll show where they're speaking in terms of which conference room, what day, what time. You can have conversations with other attendees there. We'll do push notifications. Invariably with a conference this big, somebody's flight gets delayed or somebody has a personal emergency that comes up and they may not be able to speak. So, that's where we push out notifications about that too. So I always say, if you want to go with the PDF, you can do that. We will have some brochures on site that allow you to kind of circle the types of things you want to go to. Or again, you want to save a tree and, be in 2026, like a lot of people doing things online. You've got the app right on your phone. It's a great way to keep track of what's going on and what you want to see.
Mike, I'm curious, in light of all of the flux of news that we get on a daily basis, it's really hard to keep up with it all, but a lot of it does move the market. We were joking last year that we'd be trading by tweet, and that's really not far from the truth. We are seeing executive orders on a daily, weekly, monthly basis that do move the markets. We're seeing the government invest directly into companies. We're seeing the government go into Venezuela and remove the president. We're seeing all kinds of different threads with the mortgage industry as far as, changing who can buy houses and what may happen to mortgage rates. How much does all the macro news flow play into some of the investment themes?
Yeah, you're absolutely right. I mean, we're what, only 2 weeks into the 2026 and a little less if you only include trading days. And it has been a roller coaster ride already. Even last year, a lot of left field type stuff was thrown at the markets. We all know about Liberation Day and the kind of blink and you miss it mini, not crash, but deep correction that we had that was almost as over as fast as it started. I end up revising. I always do a set of opening remarks and some charts on, when we kick off the event on stage and just try and set the stage for the event. And there's been times when I have to change my PowerPoint the night before, or at least apologize for something that might be outdated on a PowerPoint in my verbal remarks. And I feel like that definitely could be a challenge for this year, for this event. I think the important thing really is know what kind of investor or trader you are and, follow the people at the conference whose guidance and education is most applicable to that. By that, I mean, if you're somebody who day trades for a living or swing trades for 2 week periods at a time, you don't really care what somebody says about owning Berkshire Hathaway for 10 years. You want some guidance from experts who can help you use short-term technical signals, trailing stops, whatever your precise tools are to essentially navigate those short, sharp, volatile moves. If you're more long-term oriented, there's going to be people that are going to be speaking, from stage on how to take advantage of pullbacks, ignore the news, focus on the long term, use the bargains created by those sell-offs as opportunities to get in and so forth. So, I just say know yourself as an attendee, know what you are best at and what you want to get better at, and focus on those kinds of things. Because again, invariably, this is a market that had a lot thrown at it last year. And what happened? We ended up with a gain of about 16% in the S&P after 2 years where the S&P was up about 24%. I think, and a lot of our speakers have talked about this, that this is going to be a more volatile year. This is going to be one that I don't think you can really kind of count on those big gains, especially with midterm elections and other things going on, questions about the Fed, the geopolitics you mentioned. I wouldn't be surprised if at least the first quarter, if not the first half of the year, are pretty darn choppy, and it's not just going to be a sort of steady up into the right type of move for the broad markets.
So just personally for me, Mike, I'm going to this show. I want to get some investing ideas, maybe not so much trading ideas. I just don't have time to short-term trade. But I'm also going to be looking for new guests to bring on the show. Not on the metals side. We have a lot of metals guests, and we're going to be there talking metals at the Money Show. But more on the generalist side, people that have a good handle on where the markets are going and not so sector specific. How much time am I going to be able to get with them? Are these people walking around? I've already had some speakers reach out to me personally, so I'm trying to set up some meetings there. But in terms of access to the speakers and any speakers that you really recommend that you think are good generalist speakers that aren't too isolated into one or two sectors, give me the outline of what I should be expecting and who I should be targeting.
Yeah, sure. I mean, we try and when we get together as a group and try and program these events months in advance, we know people want to, hear from the keynote stages. They want to hear panel discussions and so on, but they don't want to just have, watch somebody talk on stage and then they get whisked away in a limousine and you never see them at the conference. And I'm pleased that the types of speakers we bring in, are also completely willing to answer questions after their addresses. There are multiple things like coffee breaks and exhibit hall breaks built into the program. There are some of these segments, interview segments, podcast segments, meet and greets, book signings, all that kind of stuff is built into the program. So you're not just hearing somebody talk at you from stage for 20 or 30 minutes. You're getting to ask them questions after. If you don't have time to ask in the main room, you're getting a signed copy of their books. You're going to do meet and greets, watch them do interviews. I mean, we're pleased that the speakers we bring, and we try to bring those that really are open to try and help educate, all around and throughout the event. You look at some of the big picture speakers that we have for this event, you've got a Jim Bianco with Bianco Research, who's really good on economics, big picture, interest rate trends, things like that. You've got some of our commodity specialists like a Carly Garner, who's trading oriented, but knows pretty much, or has insights into trading oil, gold, silver, you name it. So she's going to be there. You've got some of the sort of big picture sector people that are always very popular, like Dan Ives with Wedbush. He's big into technology. He's been a big proponent about the AI revolution and ways you can profit from that. And obviously, at some point, maybe the boom ends, but he's been very right for a very long time on that score. So he's worth listening to. We have some crypto-oriented people. Andrew McCormick with eToro, for example, who's going to be talking about digital assets. We have a pre-show event on Sunday that's sort of like a mini kickoff to the event. It's a couple hours of presentations on crypto, AI stocks, tech trends, and so on. So those are people that are I think, I'd highlight. And there's also, we have Dave Nadig, a very well-known ETF expert. He's going to be talking about some of the trends in that part of the market. And finally, Jason Schenker, first-time speaker in Vegas. He's the president of Prestige Economics. As his title suggests, he's very big into the macro picture, but he's also very much an economic futurist. He's been big and written, many, many books on what's going on in AI. He's very well versed in geopolitics. So he's going to do a good job of setting the stage, no pun intended, about the big picture. What's happening in geopolitics that you need to pay attention to and what it might mean for markets. What's happening in driving AI. And, we had actually, we're going to drop a podcast episode on Thursday with my brief interview to set the stage with him. And he's very much talking about, how AI will evolve, but kind of has a couple of interesting comparisons to AI will eventually become what Excel and learning how to use spreadsheets was to a previous generation of people who had to learn how to adopt that as technology. So some interesting, speakers who bring different perspectives, but those are a few of the ones that I'd throw out there and say you probably don't want to miss.
Well, Mike, in addition to all of the speakers and information sharing, I always find that at a conference, the health of the attendees makes up a big part of the takeaways. Some of the best investing ideas I ever get at conferences are from other investors, other attendees. Maybe talk about the caliber of people that show up to these events and about how many people are there and what kind of a crowd it attracts.
Yeah, absolutely. We do two of what I call big shows, which are sort of the traditional money shows slash Traders Expo program. This is one of them, the Vegas one in February. There's another one, as I mentioned earlier, that's in Orlando in October. We also have a series of symposium events, which are sort of smaller, 300 to 500 people attendees in smaller cities or different cities where we don't really host these big shows at. That would be the symposium in Dallas and Hollywood, Florida, San Francisco, and so on. This event is going to be big. You'll have more than 1,000 people through the door in terms of attendees, speakers, sponsors, everybody, exhibitors, everybody that's involved, media, and so on. And I always, and again, it's easy for me to say because I work for the company, but even before I officially joined Money Show and I attended and spoke at Money Show events, always very impressed with the caliber and the education and the knowledge and the thirst for knowledge of the people that I would meet and just spark up conversations with. You meet business owners, retirees. I always remember one conversation I had many years ago in Dallas. The man was in the oil and gas business, had a private oil and gas company, sold it, at a liquidity event, and had like $100 million that he would, a large chunk of that was handled by, his financial advisor. He was looking for ideas to, what to do with the money that he controlled himself. And it's people like that that you'll meet, you'll cross paths with. You'll get to network with. I mean, you'll make business connections if you're looking, if you're a business owner and you're looking to sort of build that network. If you're just a personal investor that's there to, again, find something to do with the part of your portfolio that you control yourself, you'll have great conversations and you'll get new ideas that way. So I'd like to think that we cast a wide net, especially at events like this big show one. And I really do think for your listeners, if you haven't been to an event, if you haven't been to a money show, this is a great place to start, see what it's about. At these big shows, unlike the symposiums, we do have a free element. You can't get it. You can get a free pass to the exhibit hall, so you can kind of kick the tires. If you want to go to keynotes, workshops, things like that, you will have to pay. But it does give you an opportunity to just sort of, again, kick the tires. Walk around, see the sponsor and exhibitor booths, and see if maybe getting something that gives you more access is what you're ultimately looking for.
Well, I'm looking forward to the show, and I'll post a link in the show notes so everyone listening can find out a little bit more information. And hey, send Chad and I questions if you want to know anything more about the show. And if you are going to be there, even better, send us those details, and we'll be sure to take some time, meet up with you. We will be set up and attending every day at this show, chatting with all the speakers and everybody else who's in attendance. I'm really looking forward to it. Mike, let's move now over to the markets, and I want to focus on something that Money Show puts out every year, and that's the top picks. Can you explain what this report is, what the idea is, and what makes up this report?
Yeah, every year, late in each calendar year, I'll reach out to dozens of our, people who speak at our events, those who have newsletters that I digest their work for, contributors that have, either been with us for years or in some cases are very new, but we really respect their work. And I'll reach out and I'll just say, hey, listen, every January we publish our top picks report. We've been doing it for a couple of decades now. And the idea is give me one more aggressive pick that's sort of, growth oriented and one more defensive income oriented type pick. A couple hundred words on each and join the report. There's always, there's some people that contribute every year. There's some who maybe in one year, but not another. There's some that are specialists in a sector, whether it's mining or biotechnology or energy. And there are some that are generalists and big picture type thinkers. So I like to kind of have just like the conferences bring sort of a smorgasbord of speakers, this report has a smorgasbord of picks from people with specialties all across the markets, and whether it's market cap, whether it's style, whether it's industry, and what have you. And we send it out. We give it out for free at the beginning of the year to anybody who signs up. And look, this is a great starting point for picks that you may not hear about elsewhere. It's not designed to be a true portfolio where if you're trying to match the S&P, you're always going to own a certain percentage of Nvidia and Meta and Microsoft and so on. This is a mix of picks that range from microcap gold miners and explorers on up to mega cap tech names. If you look at the top performers of the 2025 picks, it was not surprisingly almost all metals and a few special situations. And Avino Silver and Gold Mines ended up having the best track record, up 567% as I tracked it. You had other things like Heliostar Metals and United States Antimony that did very well. That's just a sampling. In 2026, the report that just dropped last week, we've got 68 picks from 39 different contributors. So, you're getting people that are specialists in metals, specialists in income stocks, specialists in energy, as well as generalists and so on. And, it's always interesting to see what works best. It's always interesting as a reader, and I get this feedback. People like the fact they can, get a bunch of new ideas. They're not just going to go out and buy all 68, and 100 shares of each and then just ignore them all year long, but they're going to use this as a starting point for their research. They may get some individual ideas that they like. They'll do their own research and they'll add them to get a little bit of spice to their portfolio, or see what it is that really attracted the contributor to those names.
Well, Mike, it's interesting to hear how the metals did last year, and we're familiar with some of those companies and have those companies on our show. So nice to hear that they were in some of the top ranks. I know it's very early on, extremely early on in the year, but a lot of people give a lot of weight to how the markets kick off in January, even the first week of January, the so-called January effect. Any sneak preview you can tell us about the themes that are taking off the fastest so far in 2026?
Yeah, it's funny because it's not even just 2026. The report dropped on January 7th. So to be fair, for my tracking purposes, I set up the portfolio on using the closing price of the day the report is released, which again was only a week ago. But not surprisingly, given what's happening in the defense industry in terms of geopolitics, the top performing stock so far is one of these drone companies called Red Cat Holdings, already up something like 23% in a week. Again, these sort of unique defense names, drone companies, people are interested for obvious reasons. There's a couple of the junior miners that are doing very well, even a big fund like PSLV, which just holds silver. Those are a few things that, again, given what's happening in metals and mining, are doing well. But we did have a couple other picks there. There's one Willdan Group, WLDN. It's an AI type name that's in there. That's in the top 10 this very early point. And surprisingly enough, a couple of the dividend or smaller plays are doing well. Philip Morris, Hormel Food, some of that defensive type stuff is actually out of the bat doing okay. So, it just goes to show that you never know what's going to happen at the end of the year. Obviously, I always do a look back at sort of the midway point of the year to see how things are doing, and I'll do a follow-up based on that. And then I'll circle back with the editors who contributed the best picks for the whole year and just ask what their updated thoughts are before the calendar flips. But so far, those are the types of things that are doing well. And again, I think it's kind of obvious what's driving metals, and then some of these other names are just sort of special situations or people looking for maybe income and going down the cap spectrum a little bit. You've seen small caps, mid caps doing a little better, and some of our top speakers have said it's those SMID names, to use the jargon, that potentially are going to be where you want to be this year.
What's your outlook for this year then, Mike? Because it seems like everything's off to a very fast start this year, and there's just been a slew of news out of the U.S. on so many different fronts. It's crazy to even try to recap it all, and we're only as we're recording this, the 14th day of the month. What is your outlook for this year? What's going to keep running? Where do you see some risks out there?
Yeah, I mean, I've been, as a generalist, I've been bullish on metals going all the way back to the second half of 2018. And, for a while there, it was sort of like waiting for Godot. Obviously, it's not anymore. That sector is supercharged. I still like it. But, as the moves get bigger and the intraday and intraweek and, full year moves get bigger, you do have to be careful about not going overboard and adding exposure here. I still do think there's some opportunities in some of these beaten down or underloved sectors, things like REITs, some of the high yield plays like BDCs, which got thrown out. I think some of the credit worries there might be overdone and the market might have already priced them in. I think overall that be bold thesis that I've talked about, which is essentially, offensive investing versus defense, tilting towards offensive sectors and stocks versus, I've been on that train in 2023 and it's worked out very. I'm still there, but I do think, especially whether it's the first quarter, I still think volatility is going to be the name of the game. I don't think it's going to be this sort of steady up into the right type march that we've gotten used to. And that's for a number of reasons. I mean, Shad alluded to the geopolitics. Those headlines are going to be coming out all the time. We've got questions about the Fed and Fed policy. How much are they going to cut and when? The midterm elections and what that implications are for policy. will the Trump administration continue to get what it wants, or is it going to, are we going to see more pushback? And as it looks like if the midterms are going to go the Democrats' way versus Republicans, there's all kinds of questions that are going to be dealt with and uncertainty. And I think that that is going to, particularly in the first half of the year, give us a little more unsettled trading. So be ready for it.
All right, there you go. Mike Larson, editor-in-chief at Money Show. As I said, everyone, I hope you can join us down at the conference in Las Vegas at the Paris Hotel, February 23rd to 25th. Send us any questions. Reach out to Money Show representatives and sign up if you can be in the area, because Shad and I will both be there, and very much looking forward to it and very much looking forward to seeing how this year plays out. So, Mike, thanks for taking time with us on this weekend show. Looking forward to seeing you soon in Vegas. And everyone, stick around. We're going to be right back, shifting our focus pretty much exclusively to the metals and stock sector.
Thanks, guys.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
The dynamics of the natural resource trade changes every day. Get the full view of the commodity markets every week with Commodity Compass, hosted by me, Jennifer Pickrell. From metals to energy to agriculture, we break down the key moves, market drivers, and macro forces shaping the resource world, all in one sharp, insightful podcast from the Clear Commodity Network. Whether you're a trader, investor, or industry pro, Commodity Compass helps you stay grounded and informed. Listen on Apple Podcasts, Spotify, or at clearcommodity.net. In mining, the difference between a good project and a great investment often comes down to one thing: visibility. Tara Hutton is a Sweden-based online mining investor platform built to make the invisible investable. Because a great project without a story is just data. Drill results, spreadsheets, and technical reports that never fully connect. And a great project that isn't online might as well not exist at all. Tara Hutton brings mining projects into the digital spotlight, combining data, narrative, and context in one place, so investors can see not just what a project is, but why it matters. Whether you're evaluating early-stage exploration or more advanced development assets, Tara Hutton helps turn complexity into clarity and information into insight. Visit Tara Hutton online and start discovering the stories behind the data.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And now it's time to dive into what's going on in the metals sector with our good friend Dave Erfle. Dave is the founder and editor of the Junior Miner Junkie. We're going to cover mostly precious metals, but then also touch on some of the other metals that are all also doing very well. And ask Dave what he's doing with his portfolio, or if he sees any opportunities in the underlying equities. Dave, you know where we have to start. We have to start with silver. We're recording this just before the market close on Thursday. And so far, we're 15 days through the year, which trading day-wise, we're only about 11 days, I think, of trading days. Silver's up over 30% this month. It is no doubt absolutely a spiking move here, and that's after a very good December. And quite frankly, it was the tail end of November that silver was at $50 an ounce. And now it is seemingly going to get to $100 an ounce in literally no time. Dave, I do have to ask you then, how is this spike, in your eyes, different than the last two major price spikes that we've seen really over the last 100 years that unfortunately put a top in the silver market for decades afterwards?
Yeah, Corey, that's a great question. If you're relatively new to the silver space and you're hearing about the silver price going bonkers and you want to get on the action, and then you bring up a long-term chart, and you look at a long-term chart like a 50-year chart, and you see what silver did in 1980, it made this parabolic move like it's made right now. It's made parabolic move, and then there was a crash, and there was a long multi-decade bear market following that. And then you see the same thing happen in 2011, right? We had a spike to this around the same price level, around $50, and then it crashed and it ushered in another really long bear market. So you're a newbie and you're thinking, wow, I don't want to get into this thing until it crashes. Well, the big difference is in 1980, the Hunt brothers were attempting to corner the silver market. That was a synthetic move. And the CME, the government, they came in and they basically changed the rules and put the kibosh on that and broke, and the Hunt brothers went broke and the silver market crashed. Well, 2011, the same type of thing happened. The CME raised margins 5 times in 2 weeks. And that was a speculative bubble. So when you raise margin requirements 5 times in 2 weeks on a speculative bubble, that's going to crash the market. And it did. Well, this time we've had the CME try to do this. They came in and they raised margin requirements 3 times in the space of like 2 weeks. All it did was create some profit taking for a couple of weeks. And they did it while everybody was gone over the holidays, right over the Christmas holidays. So they couldn't really react to it. So the price naturally crashed. They couldn't pay off their margins. So it went down, but it's gone right up because this time it's a supply issue. It's a critical metal now. And silver back then was mostly a precious metal and not as much an industrial metal. Well, now it's more an industrial metal. And not only that, it's a critical industrial metal. So you've got a combination of it being a critical industrial metal. It's going into its 6th year of a supply deficit. So that's the reason why we keep seeing it go higher without much corrections. And also on top of that, you've got it breaking out of a 5-year cup and handle pattern, which is the most bullish chart pattern in technical analysis, and it's 45 years. So that 45-year resistance at 50 was finally broken through. That is huge. And we're seeing the result of that. Silver's tripled in a year now.
Well, Dave, in addition to those factors from 1980 and 2011 being different, we still have a lot of other factors that are even different this time. In addition to the critical minerals designation, we also see that there is a big difference in the physical market versus the paper market. We've seen backwardation where the spot price has been higher than the futures prices, but we've also seen a big difference between the last cycle and this cycle with the Shanghai exchange. There wasn't a Shanghai exchange back in 1980 that mattered, or even in 2011, but now the shift has gone from the west to the east, and there's a big arbitrage, and that's underpinning this move as well. So it's not just a U.S. story. This is a global story, and the story has shifted to China.
Right, exactly. Now the price is being set in China in the east, and it's no longer being set in the west because now the CME has pretty much no more control over the price. I mean, it's paper over here, and it's more physical over there. And these supply issues are a very real thing. And and there's been rumors of these companies going directly to these to miners now to secure supply. So this is a real thing, and it continues. And so as this continues, the price continues to go higher.
So, Dave, if this is all about supply issues then, and quite frankly, if the price does keep on spiking, is substitution going to become a risk here?
A substitution, a risk, and maybe just as far as in the West is concerned, I mean, settling your futures contract in paper and no longer being able to take delivery because it's a critical metal now. The government come in and say, we're going to settle in paper now. We can't give you physical delivery if you want it. So we've got those issues also. And with the silver price now in a parabola, I mean, the RSI on the monthly now is at 94, and it looks like it's gonna close the month for a 6th time above its monthly Bollinger Band. So I mean, we're going to have a correction, and I think 70 is now trying to become a floor. It looks to me like 70 is trying to become a floor here after what happened with the CME margin hikes. That's where it got down to, and it kind of settled down there for a few weeks, and then it started to go right back up again on the supply issues.
Well, and I don't think there's certain industries that can swap it out. So, for example, solar panels is one of the biggest industries that uses silver. You can't swap that out with aluminum or copper. There's engine parts that would be gigantic. It wouldn't fit in a car if it was swapped out. So there's some substitution that just cannot happen no matter what the price is. But what do you make of manufacturers that are also scrambling to get supply? That's been part of the story. We've seen some manufacturers go down and make offtake agreements with the mining stocks. As manufacturers need to have these components, how is that factoring into maybe how people are using the commitment of traders and hedging and those kind of elements?
Yeah, I mean, that's it. And also, I also forgot to mention that the U.S. government shutdown postponed that Section 232 investigation on critical minerals, and that was due to be released in October. So as a result, even though a spike in the exchange for physical premium in September encouraged a return of CME inventories to London, stocks held in the vaults now in the CME have remained elevated because there's ongoing tariff uncertainty. I mean, Trump came out today and said that he's not going to be putting tariffs on silver and copper, and silver and copper both experienced some quick profit taking, but it only lasted for a few hours. And when the overnight, and then when the COMEX opened this morning, silver shot right back up to 93, and I think copper is right back up to $6 a pound.
Yeah, copper continues to do well. But again, when we're seeing this sort of price spike, 30+% in 11 trading days, that's not sustainable. That's not going to continue. And I know some of the silver bugs will disagree with me on that and just keep on upping their targets. But quite frankly, it will stop at some point going up at this rate. And then the correction will happen, which I'm sure will be pretty sharp and percentage-wise probably be a fair percentage. But then what do we do when we see that, Dave? Because again, history, and I realize this time is different, but history has shown that after price spikes, it can be very challenging for a metal or any sector to get back to these extreme levels. So what should we be expecting for, and what will you be doing after we get that spike and we get some sort of a correction, however big that correction might be?
Well, if you're asking about the physical metal, we do nothing. I mean, I continue to hold my physical metal. If you're speculating on the price via paper, via ETFs, then you want to be taking profits on the way up during a parabolic spike. But if you're talking about stocks, they're still massively undervalued. I mean, you take a look at the silver price. We talked about the silver price has tripled in the past year, in the past 12 months. So the silver price has tripled. But SIL and SILJ have also just tripled, and they historically provide leverage. Gold stocks, silver stocks, they historically provide leverage to the gold and silver price. I mean, we saw the gold price go up 65% last year, but gold stocks provided the leverage. They went up 2.5 times. But silver stocks have not done that. They've gone up just as much as the silver price. I mean, you've had to be a good stock picker to really tap into the leverage that silver stocks provide to the silver price. So, I mean, if you're asking me what I'm doing now, I've got some cash in my account after taking some profits, and I have some investment capital to deploy. And I recently recommended a early stage explorer, and it's still very cheap. They've just cashed up, and they're able to aggressively drill their high grade project. So, I mean, I'm happy that this is happening right now as far as the consolidation and the non-reaction to silver stocks, because myself and my subscribers can get into this stock on the cheap.
Well, Dave, I'm going to take the other side of that and say I'm not happy about it, because even though, like, to your point about the leverage, we're in this for the leverage and we're not seeing it. Even though silver's up 30% this year, the stocks are up half of that. If you look at silver stocks priced in silver, they're down at levels that we haven't seen since the pandemic crash in 2020 or since the 2015 low. And a lot of people got into these and they're already positioned. They're not waiting to buy the dip. They got positioned a while ago, like they should have, for the ride up. And the ride up has been exciting. But I think there's something happening that's really strange. And I'd love to get you to weigh in on this. Like, people are excited because a lot of stocks went up in 2024 and 2025. Okay, fine. Some stocks went up 3x, 4x, 5x. Great. But that was on the move to 50. After the breakout in 50, from 50 to 90, these things have not leveraged it at all. And it's not just a little bit of a delta to make up to extend the cycle. This is a huge glaring disconnect in this cycle. And a lot of people are scratching their heads wondering why we're not factoring in improved economics on developers, improved profit margins for producers. Remember, Q3 was $39. We're just about to get Q4. Even if we have a correction down to 70, that's way higher than the last 2 quarters. Why are analysts and generalists and people in the sector not bidding these things up? Is it because they're all waiting for the crash?
Well, I hear you, Shad. But I think the answer to that is a combination of a few factors. Okay. Factor number one is the stock market continues to make all-time highs. So your generalist investor is still distracted by the stock market, and they haven't really discovered the precious metals equities yet. And also, you got to consider the fact of how tiny the silver space is. With only about 20 pure play silver miners globally, the silver equity space is basically too concentrated for diversified exposure. The relatively tiny silver equity complex is too small for major institutional allocators. So basically, when hedge funds and big money investors, they want to establish positions in silver stocks, they don't have many options. And the selling pressure gets concentrated to a handful of names, so price discovery breaks down. I think the combination of all these factors is the reason why we've yet to really experience a leverage yet, but it is coming. If you take a look at the sector as a whole in relation to the stock market and in relation to metals prices, bring up charts now, the silver price to the S&P 500, that's breaking out. Silver stocks to the S&P 500, that's starting to break out. Gold stocks to the S&P 500, that is starting to break out. And I'm starting to break out by saying they're breaking out of 12-year bases. As you mentioned at the top of the program, bigger the base, the higher in space. And also the TSX Venture, it's breaking above 1,000, which is a 12-year neckline. We get a monthly close above 1,000 in a couple of weeks. That is a major breakout of a 12-year base. And the target is just the 2011 high when gold was at 1,800. Is 150% higher from where it is now.
So, Dave, one other thing that, look, I've been looking at, Chad brought this up when we did our quick take, was that SLV to silver ratio and how it is actually at low levels. And I made the comment, I got some heat for it, that I'm not too worried about that, to be honest with you. Yes, it's disappointed that here and now, early on in the year, these silver stocks aren't performing, but the top of a market isn't usually signified by the complete underperformance by stocks. When you go back in and look at what happens, it's usually the stocks get way too far ahead of themselves. Everyone gets too excited. Everyone chases the stocks higher, and then they essentially get stuck in that trade and they become long-term holders. A trade turns into a long-term position. To me, this is just leaving the door open for more investors to get into these stocks and still buy these stocks at higher levels than where they were in the last couple of years, because the metals price, which is critical to these stocks and which is something they don't control, is so much higher. And even if it does pull back to $70, even if it pulls back to $60, these stocks still have a value proposition there. Am I wrong in thinking that this is just an opportunity and could actually lead to, again, a more sustainable or even a longer bull market rather than the last innings here?
I could not have said that better, Corey. You're exactly right. The fact that the herd is yet to get in. We had the precious metals complex, the GDXJ, go up 169% last year. And as it's going higher, the volume is falling. This is telling you that generalists have still not discovered this sector yet. If you take a look at the underrepresentation, most portfolios have an average allocation of less than 1%. I've seen figures of implied gold allocation is still way down near 0.4% as far as total gold complex is concerned. We've got a long way to go. When you factor in how long the sector was in a bear market. The juniors were in a bear market from 2015, 2016, when the gold price went from 1,000 to 2,000. We had a couple of quick bull markets of like 5 months, but then went back down again. And a lot of these earlier stage companies, they did nothing. Drill results were not rewarded. They had to do everything they could to not dilute themselves out of existence. So if you're a good stock picker and you identify these companies that are de-risking the best projects and they were able to not dilute themselves out of existence, and they're able to raise money now, and they're only able to drill their projects. That's where the highest beta is right now, Corey. Sure, I still believe there's still multi-bagger potential in a lot of the stocks that I hold, the late stage companies that have already gone up 3, 4, 5, 10 times. I still think there's a big upside in those, but the biggest upside is in the higher risk early stage companies that investors have still yet to discover. And now the financing window is wide open. They're able to raise enough money to finally aggressively drill their projects.
Well, Dave, I'm going to push back again here. I guess that's my job on this call. Last year, we saw the silver stocks and the gold stocks outpacing the metals at the beginning of the year while the general stock markets were going up. So you could argue generalists were just as distracted then, but that didn't stop the stocks from outperforming the metals. It was really when we hit that October snag and pulled back from October, the middle of it, into November, that we lost momentum. And then after that, as things took off, particularly in silver, but also in gold, the stocks really never started outpacing again, and that's why things have gone flat, and they've been flat this year. Well, the stock market did great during that whole time. It didn't stop the stocks from going up, and you could even look at 2024. A lot of gold producers and silver producers went up while the NASDAQ and S&P were doing just fine. As far as generalist awareness, I've never seen so much media about silver or gold as the last couple of months. We got executive orders, we got critical minerals, we've got breaks to new high, we've got people covering the physical, we've got all these internet programs popping up on YouTube covering silver. You've got all this attention to the sector. I have generalist friends that couldn't spell silver a year ago that are now asking about it. If anything, they're less distracted than ever and more focused on the sector. And what about all the people already in the sector when they see the NPV of these developers going from a $1 billion value to a $3 or $4 billion value with gold prices and silver prices now? Why are the people in the sector not bidding up the developers? Why are they not bidding up the expectations of the margins and the revenues that we're going to see Q4, Q1? Why are people in the sector not bidding it up?
Well, in all fairness, they have been bid up. I mean, a lot of these companies gone up 3, 5, 10 times. So, I mean, some profit taking's got to occur, and it is occurring now. I mean, if you take a look at reasons, if you want to consider reasons why, where at end of the year last year, you didn't want to take some profit off the table because you'd have to pay your realized capital gains right away. You figured, hey, gold's going to continue to go up in the beginning of the year. So, the beginning of the year, I'm going to wait and take some profits then. In the U.S. today is the deadline for having to pay estimated capital gains tax. People are selling stocks to pay taxes, and you also have to factor in maybe some portfolio rebalancing at the beginning of the year. You know, I'm not frustrated. I mean, this is happening to me too, Shad. I mean, I'm not frustrated. I'm making money. My subscribers are making money. And like I said, this is just an opportunity for us to get into other things that we might have missed that are either correcting or that have yet to be discovered by the market.
Yeah, I think it is too. I even started buying a lot more financings on that break above $50. And when I saw silver not immediately correct lower, and I'm still pretty happy with those positions, and a number of them are up fairly nicely too. Look, they're all different stories out here. And I also don't blame people for not trying to chase a spiking market when one like this that gets completely out of hand. I know some people did that with some of the rare earth stocks earlier, and that ended up burning them too. So I really do believe we just need some sort of a correction here, and maybe just a little bit of slowdown in this momentum, because momentum sometimes when it's this strong does shy people away from entering those positions. But again, these stocks, I think they're still giving you an opportunity. Let's talk gold then, because gold has been, I think, much more sustainable run, and I actually really like the way the gold stocks have been performing at the tail end of last year and early this year. I've been noticing more leadership from the majors again, and that is just part of more of the bull market nature, is where I like it when the majors outperform, because that does usually mean bigger money is coming in, and quite frankly, that money will eventually filter down to the juniors. But in terms of gold and the gold equities, Dave, how are you seeing those right now?
Yeah, absolutely. I mean, look at the beginning of the year. I mean, elevated economic and geopolitical uncertainty is playing directly into the precious metals complex. And with each passing week, we seem to add another level of uncertainty. And this is encouraging investors to continue seeking safe havens. And if you take a look at the gold chart, following increasingly shorter consolidation time periods, gold continues to post fresh all-time highs. mean, gold futures hit a record high above 4,600 to begin the week. So, I mean, if you take a look at it's just the plethora of catalysts in the precious metal sector right now, especially gold. I mean, it's the 2025 perfect storm for precious metals, February 5 hurricane in 2026. I mean, U.S. interest rates are set to fall further as these geopolitical tensions are now rising with with the Donroe doctrine. The traders are pricing in 2 to 3 Fed rate cuts, despite high inflation that the Fed has pretty much kicked to the curb. We don't care about a 2%. I mean, why they keep saying that they're concentrating on this fantasy 2% target is beyond me. It's never going to get there. I mean, everything that they're doing is creating more and more inflation. I mean, 345 trillion of global sovereign debt now, escalating by the hour as the world's most powerful central bank moves closer to losing its independence from government. At the beginning of the week, Trump came out and said he was going to use the Department of Justice to try to put Fed chairman in jail just to get interest rates lower. I mean, you can't make this stuff up, and you can't get any more bullish for the gold price.
Yeah, for sure, Dave. The gold price has been a thing of beauty technically, and there's a ton of fundamental factors from central bank buying, the global diversification, lots of other nations not wanting to be in the same spot that Venezuela or Russia have been in. So they're looking at getting out of U.S. dollars and shoring up their gold reserves. The gold stocks, the producers, to Corey's point, have done really well, the seniors and even some of the mid-tiers. But when you look at the development stage companies, we still have a similar issue where the value is going up so quickly on paper that the stocks have not tracked how much their value has gone up. Are you using a certain price assumption when you evaluate development stage companies? When you look at a PFS or a FS, a pre-feasibility study or a feasibility study, are there any metrics that you use to try to determine how much a stock still could catch up to its valuation?
Yeah, I mean, I'm looking at peer comparisons when I'm looking at a certain subsector in the market. Like right now, I'm trying to find earlier stage companies because, like I said earlier, I feel that's where the higher beta is right now down the food chain. I mean, it happens in the equities, right? I mean, the majors go first, the mid tiers or royalty firms they go first, and then the later stages. And then the earlier stage development plays. But now I'm looking at for the first time in years, drill plays or companies that are about to release a maiden resource. So I'm looking at peer comparisons, right? Valuations. And also, you look at the jurisdictions they're in. If you're looking at peer comparisons, okay, why is it cheaper? Is it cheaper than this company? Is it worth the risk? And you have to look at share structures. You have to look at management. You have to look at were they good stewards of capital during this this decade-long junior bear market that we were in. Companies that they had to issue so many shares, and they've got all these warrants out that it's going to limit the upside on their share price. And also retail floats. You don't want too big of a retail float because then there's going to be not as much upside in the stock. But you don't want too little of a retail float either. You want to have some retail investment in the stock. So there's all these things you have to factor in. But like I said, it's earlier stage companies now that are providing the highest beta because they're the highest risk. So we're now down to that bottom of the junior totem pole where the higher risk companies now are providing the best.
So Dave, to that point about the development stage companies, quite frankly, right now there's way more development stage companies because everybody is looking at some sort of production. But look, when you're looking, I guess, comparing their peers, they are being valued, I guess, fairly consistently, we could say. I'm sure there are standouts to the high side and the low side as well. But is there a problem that we have too many development companies? Or is it the fact that these companies, they just need to get their asset built to get that re-rate, and they're not going to get it beforehand? What is the problem with the development companies that it sounds like you're even skipping by them now and moving to the smaller companies?
Well, the reason why I'm skipping a development because I'm in plenty of them, and we have so many gains in the ones that we're getting too big, and we're trimming from them, and from with the capital that we're trimming off these stocks. That's the capital I'm using to get in these higher beta companies, because a lot of these later stage companies, their stock charts look like hockey sticks. And like I said earlier, although I believe there's still plenty of upside in these stocks, even though they've run quite a bit. The highest beta is in the higher risk companies. So I think this is where you need to look. But like I said, it's higher risk, but higher risk is higher reward. I mean, a lot of these companies are trading, below 200 million market cap because while they're de-risking their projects, now they're de-risking projects in a bull market where their share price is going up with the sector. So they can dilute later at higher prices and it's less dilution. And they don't have to offer warrants because their projects are so good. You have to make sure that their projects are good enough to not offer a warrant also. I would put that caveat in there. So yeah, I mean it's all good is in the space now. But like I said, that bigger beta is in the higher risk companies. But with higher risk comes higher reward.
Dave, why don't you think we're seeing more M&A than we are? And when we do see M&A, why aren't we seeing companies paying a bigger multiple when we have $4,600 gold and margins of between 2,000 and 2,500? Some companies even have $3,000 margins right now. Why are they only paying $50 to $100 an ounce in the ground?
Yeah, that's a great question. I mean, I think it all goes back to the previous bear market. I mean, the previous bear market was, I mean, they did so many things. They were terrible stewards of capital. They racked up enormous debt. They acquired projects that were uneconomic, and they acquired the projects with their paper. So they over diluted, and like I said, they were terrible stewards of capital. Well, they've learned all those lessons now. Now they're paying dividends. They're paying down debt. They've got plenty of cash. They're making sure not to overpay for projects. I mean, they're all in the same boat. They're being very cautious. And that's a good thing because eventually they're going to have to really start ramping up M&A because they got to replace these ounces. And as far as I'm concerned, they could take their time because my stocks now are going up on their own. My biggest worry on a lot of these stocks that I own that have already gone up so much is that they're going to get taken out too soon, like the one that we've talked about in the past, Probe. Just that sale went through this week. I sold it on Monday and four-bagger out of it. I know so I'm not going to get a lot of sympathy from people that, oh, gee, too bad, you only made 4 times your money on it. But we got into the stock a long time ago, back in 2020, and as the company de-risked the project up to over 10 million ounces in a fantastic jurisdiction, we thought we were going to get a lot more than $58 an ounce. But hey, that's okay because now the timing of the takeout was great and it was a cash offer. It was the end of the year, so I could wait to sell the stock because I knew I was going to get a certain amount for it. If I'd have sold it last year, I would have had to immediately pay the capital gains. I went ahead and waited until the beginning of this year, and I sold the stock at a nice gain, at a really nice 4 times gain, and I don't have to pay capital gains for another 14 months. So, it's all good. I'm not really complaining, but like I said, I mean, we were hoping to get a lot more for that, but that's okay because we're able to rotate that money now into some of these higher beta, higher risk companies.
Yeah, it's really been a theme for me too, is rotate some of these wins and not take the full win off the table, but take some of that win off the table and find these other opportunities and rotate it in. I buy a lot of private placements, and boy, oh boy, I did a whole lot of that last year, and I'm even working on that early this year as well. Dave, we've had some technical issues here, so let's get you out of here with one more question. Other metals, copper, that continues to run higher. I actually see a huge opportunity for copper, and I've been also impressed at how the majors have been doing very well, and I've noticed a lot more action in some of the juniors and some of the bit higher quality mid-tiers. But there's also nickel, there's lithium's back on the table, uranium's running higher, tin's running higher. Everyone's talking about now all these other metals that are moving higher. Which ones, if any, have your attention?
Well, I'm still sticking with gold, silver, and copper, Corey. Like you said, I really like copper also. I think, it's breaking out of a 4-year base here now. And it's breaking out of there. And, I got my subscribers into a couple of silver plays already. One that I got us into at the end of July is already almost quadrupled. So, yeah, I really like the copper space here.
Okay. Dave, we'll wrap it up here. Thank you for taking time with us on this weekend show. Everyone, thanks for tuning in to this weekend show. Hope you enjoyed the commentary in the first and second half of the show. And I hope you also go back through our website, podcast, YouTube channel, and Substack account to catch up on all our daily editorials and company updates from throughout the week. It was another pretty busy week for us. Still waiting for a lot of news to come out of these companies. But boy, oh boy, we got a lot of commentary on what was going on with silver. And look, there seems to be a few divided factions here of what they're hoping for and what they're expecting in the silver space. So everyone, go back, listen to those daily editorials and company updates, and be sure to tune in throughout next week because we have another pretty full week for you all covering market moves and companies. So Dave, thank you again for your time, and everyone, thanks for tuning in this weekend. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.